Welcome to today's market report.
European stock markets are set to edge higher Thursday, with investors hopefully of more government help to sustain the economic recovery while remaining wary of the mounting coronavirus cases ahead of the new earnings season. At 7 o'clock this morning, the DAX futures contract in Germany traded 0.2% higher. CAC 40 futures in France were up 0.8%, while FTSE 100 futures contract in the UK rose 0.6%. Finance ministers from the euro area are due to meet virtually on Thursday ahead of a summit of their leaders on July the 17th to 18th, and there will be discussion over the bloc's multi-year budget as well as proposed 750 euro billion recovery fund for economies hit hardest by COVID-19. There is a degree of optimism within the market that a deal will be struck between the mainly northern European nations that want the funds to be made available primarily as loans, i.e. to be repaid, and those hardest hit and more fiscally challenged further south that seek grants. On Wednesday, the UK government detailed its latest pandemic economic rescue plan with a sticker price of £30 billion, aimed at getting consumers to support businesses as they reopen after 3 months of lockdown. The need for this new injection of stimulus is becoming more apparent. Although Europe as a whole appears to have done a good job of containing the COVID-19 virus, the European Commission revised its economic forecasts for this year downward to show a contract of 8.7% in the Eurozone. There are now over 12 million global cases, according to Johns Hopkins University data, with a number of countries reimposing lockdowns to curb fresh outbreaks. The US, the world's economic engine, has posted its largest number of daily new infections since the outbreak began, and investors will be wary of what the new earnings season will deliver. Oil prices stagnated on Thursday despite US government data showing Wednesday that gasoline stockpiles fell by much more than expected as demand climbed to its highest level since late March. Prices have been held in a narrow band over the past 2 weeks as concerns about a spike in coronavirus cases globally tempers optimism about a recovery in fuel demand. US crude futures this morning traded 0.3% lower at $40.77 a barrel. The international benchmark Brent contract fell 0.2% to $43.2. Gold futures rose 0.1% to $1,822.65 per ounce. On the FX front, GBP USD has surged above 126, partly encouraged by the new 30 billion sterling fiscal stimulus plan laid out by Rishi Sunak. The detailed program includes a job retention scheme and other means of boosting the economy. FX strategists at OCBC Bank set the target for this extension at 126.98, which is the 200-day moving average. The euro-dollar pair is gaining 0.23% at 113.55, though Thursday's 4-hour chart is pointing to overbought conditions, which implies a downward correction. The solid move from investors towards the riskier assets puts the buck under extra downside pressure and forces the US dollar index to recede to multi-week lows, all within the generalized upbeat context for stocks and commodities. Earlier in the session, the German trade surplus expanded to 7.6 billion euros in May, with exports and imports expanding by 9% and 3.5% respectively. The current account surplus, on the flip side, shrunk to 6.5 billion euros in the same period. Later, the Eurogroup meeting is expected to appoint a new president following the resignation of Mario Centeno in early June. Data across the pond will include the usual initial claims as well as wholesale inventories for the month of May,
With this in mind, focus will quickly turn to the release of the weekly unemployment data from the US later in the session. Jobs trends have been positive as states and cities come back from COVID lockdowns, but some areas have now been forced to slow down or reverse reopenings. Initial jobless claims are expected to be 1.4 million for the week ending 3rd of July.
The dollar-Chinese yuan pair slid 0.2% to 6.9878. The yuan was boosted by better-than-expected inflation data for June, with producer prices falling 3% year-on-year. The drop on the PPI was smaller compared with the previous month's drop of 3.7% and the 3.2% drop analysts had generally forecast. However, the pair is being supported mostly by the rally in Chinese stocks, which continued for an 8th straight day on Thursday.
This is today's market news. Thanks for listening. We'll see you next time.